Hello there, and so glad you could join us tonight. It's often been said where oil goes, the loonie follows. So ever since the collapse of the price of oil in 2014, not surprisingly, the loonie has been falling as well. Sometimes a picture really is worth 1,000 words. Take a look at this chart showing WTI oil prices and the Canadian dollar. And you can see the loonie has pretty much tracked the ups and downs of oil prices. Now, up until the start of this year, the path has generally been down, but since then, the Canadian dollar has had quite a swift recovery from 68 cents all the way back up to 80 cents US. But where is it going from here? Earlier, I spoke with David McCullough. He's a senior portfolio manager at TD Asset Management, and I asked him that and a few other questions about the loonie's volatility.
You look at the loonie, it's been a roller coaster ride. It went from worst to first. In January, we were at 12-year lows against the greenback, and then a few weeks later, we're year-to-date best currency in the world. So roller coaster ride. What really changed was the drivers that drove the fundamentals of the Canadian dollar.
So what are some of those fundamentals?
The two most important drivers, the value of the Canadian dollar, is interest rate differentials, primarily between US and Canada when you're looking at dollar Canada, and net exports. And you can simplify net exports and say really commodity prices. So interest rate differentials and commodity prices are driving the currency. And that explained how we got to 69 cents. Also explained the rise up to 80 cents.
Why, you say the interest rate differentials. I mean, explain this a little more if you could, because, there were no interest rate or significant interest rate changes, I don't think, between that 69 to 80 cent point, or was there? Like, what happened that caused that to happen?
Let's step back. The descent of the Canadian dollar really started years ago. Like, it declined in 2011, 2012, 2013. The descent really gained some traction in 2015. Recall in January 2015, the Bank of Canada surprised markets by cutting rates unexpectedly. And why did they do that? Oil was falling, the Canadian economy was going to slow as a result. It was a precautionary measure, but the market wasn't expecting it, and it really caused the Canadian dollar to sell off. Fall along the year, the oil is falling, further cuts by the Bank of Canada, and suddenly we're nearing 69 cents. January of 2016, the market's expecting the Bank of Canada cut rates further. Well, they don't this time. And that was the turning point. So January 20th, 2016, market was really expecting the bank to cut rates. They didn't. Whether you call it short covering, change of position, change of view, change of sentiment, Canadian dollar appreciated. Now,
and rapidly at that.
And you look at some other drivers, price of oil. Coincidentally, it bottomed on January 20th. So suddenly, the price of oil starts basing it and then climbing, further support for the Canadian dollar.
So here's the question that everybody wants to know who's watching. Okay, we've gone from 69 to 80, now what? Where are we going from here?
Well, you look at, is everything priced in? Are we priced to perfection? In my opinion, yes. You look at where rates are right now, you look at where the price of oil is, I think it's as good as it gets for the Canadian dollar. I think the Canadian dollar weakens from here. And going back to the drivers, interest rate differentials, I base that on the assumption that the Bank of Canada is really on hold this year and probably most of 2017. On the US side, the Federal Reserve is likely to raise rates sometime in 2016 and then further in 2017. So the interest rate differential is going to swing in favor of the US dollar, and that's going to support the US dollar relative to the Canadian dollar.
So you're seeing levels right around what by the end of the year?
I think you look out 12 months, 73 cents, 75 cents.
There are some outliers, who are kind of looking at the loonie now, and I wouldn't say this is the norm, who's saying we could see it go sub 60 again. What kind of conditions would you need to see a loonie head in that direction?
Well, again, go back to the inputs, interest rate differentials, price of commodities. The one thing I did mention, part of the ascent to 80 cents was, although our economic data seemed okay in absolute terms, on a relative basis to expectations, really exceeded expectations. So factor those in. To get to 60 cents, you need to sell off in oil, or you need a real slowdown in growth, so flight to quality to the US dollar, or you need interest rate differentials to swing more in the US's favor.
And that was David McCullough. He's Senior Portfolio Manager with TD Asset Management.